Big tech is on a roll, and it has been for quite some time. We had Microsoft, Google, Meta, and Amazon report this week, and they all beat their earnings and their revenue numbers. So this is something that's quite exciting, especially because a lot of the market did not have these expectations. I think they expected a lot of misses. So we are going to look at the earnings of these companies, some highlights, and then I'm going to give you some important opinions of mine at the end and provide some caution with big tech companies. So if you hold big tech, you'll want to see this video till the end. But let's start with my portfolio performance. This is something I share with every single video. If you like that type of transparency, be sure to subscribe. I am up 4.64%. This is the most I've been in the green for, it's been a long time, shall we say. But of course, a lot of earnings, a lot of the companies are beating expectations. So the whole market's lifted as a whole. And you'll see here my two big tech companies, Microsoft, which is up almost 30% for me, and Amazon popped in the green at almost 3%. It's just been really good. So let's dive right in. Let's start with Microsoft. I'm going to rate this company's earnings an 8 out of 10. Now they beat their earnings per share by 9.67% and their revenue by 3.59%. So some decent numbers. If we look at the main items I want to show you that I think are really important, the cash. Now the cash has increased all the last 5 quarters except for one. So anything in green is an increase. Anything in red is a decrease from the prior quarter. And then I drew that orange line just so you can see when I say compared to prior year, it's comparing to the prior year's third quarter, and they just reported this year's third quarter. So cash, again, really it's remained flat since a year ago, and overall it's increased except for one quarter. Now their debt, I love to see this. Every quarter it's been decreasing. This is such a positive for me. I really like companies that are low leverage and pay down their debt. So this is a 5 out of 5 is their debt, reducing that debt every quarter. Sales, they only had one quarter that went down. All the other quarters went up, and it's higher than a year ago. Their net income, similar situation, and it's higher from a year ago. Their operating cash flows, this one, it went up 4 of the last 5 quarters. It went down there in quarter 1, but it is lower than a year ago. And so that's just something to keep in mind, but I still think it's very strong. Now, if we look at the metrics that I put together and fill out, so this is kind of a different way to look at things. Microsoft is now at a 32 PE ratio. This is higher than its 5-year average of a 31.36, and I've said for a long time now in a lot of my videos that I think Microsoft is undervalued at $290 or below, and I've had a lot of pushback. A lot of people say, no, I'm going to wait till it gets below 200, and you have those few people that are a little ridiculous and say, oh, I'll buy it at 50 bucks. But you know they're just kind of saying that to say it. But really, I think Microsoft is now overvalued. Now their earnings per share versus last year went down 3.65%. Their revenue grew over the trailing 12 months 7.81%. Their operating cash flow is lower at that 8.69%. We saw that in the last picture. And they do have a good payout ratio of 30%, but their yield's a little lower, and it's now fallen below 1%, where it was sitting just above it for quite some time. Their gross margins are good, return on equity is good, their total debt to assets is low at 21.29%. They reduce their shares outstanding every quarter, which is fantastic, and it now popped above a 2 trillion market cap at 2.2. So Microsoft overall an 8 out of 10. It did really well. Some slowdown in some areas, but I'm very happy and very excited that this is my largest holding. Now Google, I'm going to rate one lower, a 7 out of 10. They beat their earnings per share by 9.21% and their revenue by 1.43%. If we look here, overall there's a lot more red than with Microsoft. So with their cash, they had 3 quarters of decreasing cash, and only this recent quarter went up a little bit, but it's still lower than a year ago. Now their debt increased 3 of the last 5 quarters, and really it did increase from a year ago, just slightly, but it's above it, so I don't like that. Now their sales went down this recent quarter from last, but it is above what it was a year ago, so that is somewhat of a shining light. Their net income, it struggled over the last 5 quarters and went down 3 of the last 5 quarters, and it did go up now, but it is still lower than a year ago. Their operating cash flow was doing well over the last 5 quarters, except for this one where it dipped down, and now it's lower than a year ago. So that's not a good thing for me as well. We see a little bit more slowdown with Google than we did with Microsoft, and not so many positives. If we look at their metrics chart that I put together, they are also above their 5-year historical PE ratio, and they sit at a 23.1. I don't hold Google because out of all the big tech, I don't know, there's something about it I don't really care for, but it's still a great company, don't get me wrong. Now their earnings per share went down 18.78% over the last trailing 12 months versus the prior trailing 12 months. Their revenue growth over the trailing 12 months was 5.28%, so that's good. Their operating cash flow went down 6.36%, which isn't horrible. I mean, this is happening with a lot of companies this year. They don't pay a dividend. Their gross margins and their return on equity and their total debt to asset numbers are all really good. So that is a positive if you hold Google. They are reducing their shares outstanding, which is great, and their market cap is at a 1.32 trillion number there. So I will say with Google, the one thing with them is I think they do have some pressure from Microsoft. I'm going to talk about that at the end, but overall, some decent earnings, and they did beat expectations. Now let's move to Meta. I rate them even lower at a 6 out of 10. Now they beat on their earnings per share pretty massively at 30.73% and their revenue at 3.57%. But if we look at this chart, there's a lot of red on here, and their cash is not the best position. It went down this last quarter, in fact, 3 of the last 5 quarters, and it's down from a year ago. Their debt has been going up every single quarter. It's the very opposite of Microsoft's. I don't like to see that at all. Their sales, they went down last quarter, but they are higher than a year ago. So that's kind of a shining light in this sea of red. Their net income went down this last quarter, and out of the last 5, it went down 4 of those 5, and it's lower than a year ago. Operating cash flow, it's been on a good trend, but it went down this last quarter and is lower than a year ago. So really, Meta's stock popped pretty heavily. I did sell out of this a few weeks ago. I wish I would have held on, but you just can't see the future. So I got out at break even. If I would have held strong, I could have made, some okay money, but really I still stick with why I sold, and so it doesn't hurt too bad because I think long term there's just better options, and I do question the long-term strength of Meta. Now if we look at their other metrics chart, they are now also above this. It's like a repeat. Their PE ratio trailing 12 months is above their last 5-year average, where it's been the opposite for a long time with tech, but now we're seeing them get expensive, and they're sitting at a 25.98, and their earnings per share went down almost 40%. It's at 39% from the trailing 12 months versus the prior trailing 12 months. The revenue trailing 12 months growth is down almost 2%. Their operating cash flow went down just slightly. They don't pay a dividend. Their gross margins are excellent. Return on equity is a little low. Total debt to assets is good at a 13.63%. Now, their shares outstanding stayed the same. I don't like to see this. They're not utilizing that cash to help investors. So that's one thing to keep in mind. And they're sitting at a 547 billion market cap. Lastly is Amazon. I put them a little higher than Meta and at the same as Google. I give them a 7 out of 10. So they really knocked it out of the park with their EPS, and they beat by 42.17%, and they beat their revenue expectations by 2.21%. Now, this company looks better than Meta, and we'll see here that with their cash, they had 3 quarters that went down. This last quarter was one of them from the prior quarter, and they are lower with their cash balance than they were a year ago, but not by too much. Their debt was going up 3 of the last 5 quarters, but they did reduce it this last quarter, which is good, but the bad is it's still higher than it was a year ago. Now their sales were on a good trend up, but did go down this last quarter, but as a positive, it's higher than a year ago, so that's good. Net income has increased almost every quarter except for one, and this current quarter is higher than a year ago, which is awesome. In fact, they had a net loss a year ago. Operating cash flow was on a good trend. It did go down pretty significantly this last quarter, so that's something to look into and keep in mind. If we look at their metrics, now the one thing, some of these numbers are going to be shocking, but with Amazon, if you know anything about this company and how they operate, they have wild swings in their operations, in their cash flow, their earnings, so you got to take them with a grain of salt. So their PE ratio trailing 12 months is at a staggering 261.48, where their 5-year average is a 97.03. Again, take that with a grain of salt because it can be negative next quarter. It's just how they have operated for a long time now. That's why you got to look beyond the numbers with companies as well and look at the quality. Sometimes that paints an added or different picture that will help you make decisions. So earnings per share, trailing 12 months versus prior, went down almost 80%. Last 5 years, it went up, though, 67.61%. Their trailing 12 months revenue growth is almost at a 10%, which is good. Their operating cash flow went up a staggering 271.61%. So again, they have these wild swings. You can't pay too close attention because the next quarter it could be down massively. They just don't smooth it out like a lot of the other companies do. They don't pay a dividend. Their gross margin is good at 53%. Their return on equity is low at a 3.02%. But I will say, when I was updating this last time, their return on equity was negative. Now, their total debt to assets is good at a 34.95, but the highest among these four that we're talking about. Now, their shares outstanding are going up. I do not like that, and they've been going up for quite some time. That dilutes the shares that we have, which is not good, and their market cap is at a 1.13 trillion. All right, that was a lot. So the big tech summary, what I have to share with you guys that I think is super important. So these companies, their earnings were better than expected, but there was still some slowdowns, as you saw with many of these numbers from a year ago or even the last quarter. So remember, these companies started laying off and cutting costs starting last year. So we probably are seeing the positive effects of that now, and maybe people just didn't expect it to be so positive. So we may see some pain in the coming quarters when their cost cutting wears off and a possible recession hits, which means a slowdown in spending overall from consumers and businesses, which will hit every one of these companies. Now, the ad revenue did rebound with Amazon and Meta, but it fell for Google, aka YouTube, which is interesting. I'm not sure what happened there. But Amazon and Meta, I think Amazon has a great ad business. I mean, you're on the app, and as you're looking for things, you're seeing ads for others, and you click on that. It's just pretty good. And Meta had growth in its users, so obviously their advertisement dollars are going to go up. And overall, for the remainder of the year, they're predicting ad revenue is expected to grow. Now, Microsoft, their sales grew 7% after previous years of double-digit growth. So though it grew, you have to keep in mind, it's, again, slower than it has been. But Microsoft did say that AI-powered Bing has brought in over 100 million plus daily users. So it's working. The ChatGPT AI integration to Bing is working. And I have to say, I really like Bing. I've been using Bing more often than Google. I go between both, and I like the look of Bing so much more. So they're doing something really good here. And again, Google, I think, will hold the dominant market share here, but I think Microsoft has a chance of chipping away more than people thought. So Meta's CEO, Mark Zuckerberg, said that AI boosted social engagement across its many different social media apps, which is great. And Microsoft said AI would drive revenue growth with its productivity tools. So AI was a big takeaway with all of these companies' earnings, and it's paving the way for their future of profits is what they're telling us. So that's something to keep in mind as a long-term investor. Now, cloud growth is cooling, but again, it held up better than expected. And when anything, whether you beat your earnings slightly or an area like the cloud growth doesn't decline as much as expected, once you beat expectations, it seems like the market reacts and boom, there goes up your stock price. So will this keep up? I say remain cautious. Earnings expectations were already low, so the fact that they beat them, it's not like a knockout of the park, but it is good, but not as good as I think people are thinking. And with a possible upcoming recession, I say you need to buy smart with tech companies because we could see a slowdown coming up that just wasn't baked in with this quarter due to the past cost-cutting measures and maybe things that were introduced like AI that kind of drove attention and growth to these companies. So my question for you is, do you think tech will remain on a roll, or is this the calm before the storm? Will these companies start to really struggle for the next year or two should this recession hit, pullback in spending? And with tech being on such a run for such a positive run for such a long time, will we start to see maybe a few years of struggle? I don't know. If I had to put my opinion forth, I do see some struggles going forward because your cost-cutting measures will only hit the, financials for so long before reality comes in, and you can't really squeeze too much out of that anymore. But that's just my opinion. So let me know what you think. Thank you guys so much for joining. Be sure to subscribe, and we'll see you next time on Mark Arnold's Finance.